Hello and welcome to Industry155 Shareholders Debrief. In the following, we will discuss our mission statement, our products, and how we plan to improve our company. Our mission statement. We build trust and teamwork to effectively provide our customers with affordable and reliable technology to allow us to meet and exceed customer expectations while promoting personal employee growth. Our mantra. Affordable and reliable technology. How well did we live up to our mission statement? We believe we have lived up to our mission statement and mantra by delivering our customers affordable and reliable products while staying competitive with the market. We were able to have low-tech products with competitive specs while keeping our prices down, which meant our customers were getting good products for a better price. Projecting out 4 more years. How well will we do? As a company, thinking about where we want to be in 4 years, we see CapSim having the best products in the low-tech market. We also want to see our stock price continue to rise. In the last 8 years, we have come from one of the bottom stock prices to number 2. We hope to continue to the top. We also plan to continue to have a number of products in low-tech, from low, mid, and upper range of the market, and plan to do the same with high-tech products.
Our company's focus on low-tech market was simple: to guarantee reliable and affordable products. Our products followed a product life cycle, and it was systematic as each product would be high tier. This would be like the retired high-tech products. And as the product aged, it entered into the mid-tier and then the lower tier, therefore reducing costs and also price. Then it would be retired and removed from the market. The management, which was our team, evaluated price point, projection, and needed capacity, sales and production budgets, and market share annually. Now this would be adjusted in a different business atmosphere, as companies would evaluate more than just simply once a year. Because of the need for high-tech markets, this requires constant innovation and new technology. It is very expensive to maintain and upgrade equipment, capacity, and also the products in this market. Our vision was once that a product would be introduced into the high-tech arena, it provided not only benefit for the high-tech market, but it had a greater life cycle because of the demand that it could produce in the low-tech market. Therefore, it was beneficial to participate but not create a focus on the high-tech market. As a company, the greatest factor was the market share. Baldwin suppressed those in the low-tech market by garnering 33.5% of it. However, we were able to maintain a strong presence with over 20%. The high-tech market was much more competitive, and the high cost limited our presence. This allowed Andrews and Ferris to corner the market with the 54.9% between the two of them. As we reflect on the overall strongest competitor in this business or industry, it would be Andrews. It was because of their strong sales and their market presence. Fortunately, we lost market share because of product delays and the lack of product availability. Therefore, we anticipate being able to gain back market shares in round 9. We anticipate our sales of return to dip slightly due to this, which is about 2%, for a return of only 20.2%. Our return on assets will increase by 0.7% to be at 20.4%. The return on equity is looking promising with the 2% increase to be at 39.7%. But this has grown over 20% the past 8 years. Our team is evaluating the asset turnover rate, which is currently sitting at 0.86, and is assessing the need to increase revenue and maintain production. Also, to review the forecasting to ensure that excess inventory is not in our warehouses. Continuing to focus on sales and promotional budgets to ensure that our customer needs are being met and they have access through many different resources to increase our market share and the revenues. Our stock prices have increased over 640% in the last 8 years, with the greatest increase in the last 4. We look forward to our continuing growth and our projected price of over $104.
If given 4 more years to manage, we would make the following changes to our low-tech. We would have 4 products total in the industry over the next 4 years. We would keep EAT at a low price with ideal range and have the market share move back to 11% where it was in previous rounds. We would also have Echo stay between 7 to 8% of market share by keeping low price with lower than ideal specifications. Excel will be better than ideal spot for this year and ideal performance and close to the ideal size for the next round. We will not have to move that till the next year. Eve is currently a high-tech product but will drop to a low-tech product over the next 4 years. So we will only need to change the MTBFs and price over the time. High-tech products, Eve will sell in high and low-tech for a little while and then we'll move to low-tech. Aero will move to our lower priced high-tech item and then we will add 2 additional high-tech products to come out of R&D with lower automation than we currently have. This will allow us to cater to the top specifications of high-tech segment each year. For the market share for low-tech, we currently have 20% of the market share. We would want to increase this to 30% and we can meet this goal by increasing our sales budgets and decreasing our price over the next 3 years and having 4 products in the industry serving different customer needs. In our high-tech market, we currently have 16% market share, which we would like to increase up to 25%. We believe we can meet this goal by introducing 2 new products, along with an automation rate of between 6 to 7. Capacity, we will look to increase our capacity on our buildings by 8 to 10% every year, which we will review every year in case things change and we may need to retire a product. We'll also look to introduce our new high-tech products with a starting capacity at $300,000. Finance. We have been borrowing current debt and long-term debt in order for our leverage and working capital to be close to the ideal range. We are now financially in a better position than we have been previously with $20 million in profits last year. We will eventually want to fund our investments by the revenue received from customers, which we should be able to work towards and reduce borrowing by 60 to 70% over the next 4 years. We would like to pay dividends every 2nd or even 3rd year, and not every year, but instead use the money to invest back in the business. We would also like to see our stock price continue to rise. Decision making. We were able to come to decisions by looking at the financial ratios and current position and predicting where we wanted to be in the next 2 years, so that we would make informed decisions for the long term and not just the short term. Sometimes we were a little conservative, but despite having lower sales in many years, our profits were comparable to the competition in the industry and our contribution margins have been the highest in the industry for the last 3 years. This has been due to the attention to detail that the group has made in predicting growth and forecasting where we would want to be in the long run. We have also realized that in order to stay competitive, we need to introduce products at a good time, which takes some balancing to make sure it's benefiting the company. Critical incidents. We moved our automation on all our products to 10 and we could have moved our high-tech products to a lower rate in order to stay in R&D less. We also didn't predict high enough sales on our new products that came out for the first year, which had us stocking out a number of times and we missed out on possible sales. We also dropped our price early due to high automation and lower costs, so we were able to offer the lowest price in the industry, but we could have moved our product to different specifications to stay within the ideal range and gain more of the market share.